First, I just want to say a special thanks to the Center, the Caribbean Center for Competitiveness, for inviting me to be a part of this very important conference. And also, I want to acknowledge and say thanks to the ACCA for agreeing to partner with me in giving this presentation. So my topic is about preparing SMEs for commercial and alternative financing. And really, the tool that I'm going to speak to you about is a tool called SME Ratings. It's something that we in CARICRIS developed in-house, specially tailored for the Caribbean. And the concept behind the SME Ratings is that first of all, we recognize that really, if we're talking about sustainable growth and development in the Caribbean, it must come by way of the SME sector. And we also recognize the fact that the key problem with SMEs is access to finance, and not just availability of finance as was established, but can the SMEs outside there really get their hands on the appropriate funding that they need to grow and develop? And that really is the issue that we need to deal with. And as a rating agency that is based in the Caribbean and here to serve the Caribbean, we have put our minds together to try and develop a tool to address this issue. Now, one of the problems that we identify in SMEs' access to funding is really that there's an information gap between the SMEs themselves, the seekers of funding, and the banks and the lenders, the providers of funding. And because of this information gap, the SMEs actually pay for that in terms of a higher interest rate, because a premium is charged, a risk premium is added on, because due to the fact that lending agencies, they associate a high level of risk to the SME sector, and they don't really distinguish that within that sector there are actually some very strong, well-performing companies. So the SME rating gets to the heart of that in the sense that it's a performance grading and a performance assessment of the SME. And we have rankings ranging from SME 1, which represents an excellent firm, right down to SME 5, which is a weak or vulnerable firm. And apart from the rating, a complete diagnostic report is done to accompany the rating, which really gets into things like the firm's strengths, weaknesses, the products and services, information on the promoters, the shareholders, management, financial analysis of the firm, and also financial projections to show where this firm is going in the year ahead. Now, the framework that we use is that we look at four main pillars: the industry risk, business risk, management risk, and financial risk. And then we combine all these four together to come up with the final performance grading. In coming up with this model, we actually looked at what the commercial banks, what they do, what they assess before they decide to grant a loan. And we made sure that all of the different aspects that they look at, and the commercial banks look at typically the 5 C's, right, of credit. And we ensured that those things were actually included within this model and even more. So that if we start at the industry risk level, what we are of the view that SMEs operate within a particular framework, within a particular industry, and therefore sometimes a lot of the risks that they face are actually within that industry itself. So we take a top-down approach in the sense that we would first identify which industry is this SME operating in: construction, manufacturing, plastics, printing, and so on. And we identify the risks which are common to all the companies operating in this particular industry. So we are not firm-specific yet. We're dealing with a broader level, industry level. And that helps us to understand, really, place the risk of the SME in context. And so here now you would be looking at what are the prospects for this industry overall. I mean, is it poised for growth? Is it a dying industry? What is the demand-supply scenario like? How many players are in this particular industry? Because that gives you an idea of opportunity for growth for the SME within that sector. Then you would look at the importance of the industry to the economy, because obviously if it's a very important industry, you will find that there is going to be a lot of support from the government in ensuring that this industry survives and grows even in hard times. So, you know, you would look at the impact of government regulations, government support, there might be subsidies, there might be some soft loans available. You take all of that into consideration. And then you look at the key input risk into the industry. Again, usually you would look at labor, the variability of labor, raw material, and prices in general. Then we go down to the firm itself and we look at the business risk of the firm. So here you are analyzing now the market position of this SME. So, you know, you're trying to identify how is this SME competing? What are its competitive advantages? Is it cost? Technology? Is it competing in terms of quality, brand equity, things like strong marketing network and distribution strengths? So you're trying to identify what are the real strengths, the competitive advantages of the SME. And overall, its ability to sustain growth, volume growth and revenue generation. Because at the end of the day, what the banks and the funding agencies are looking for is the ability for this SME to continuously generate cash to be able to meet its debt obligations. So you would also look at the market share of the firm to try to get an idea of, you know, is it increasing market share? What is it doing to at least sustain its market share? The product range, is it a one product firm, or there are several products so that if in case one is not doing well, it can rely on the others? Customer concentration, how many customers does the firm have? Is it just one or two large customers so that if it loses any one of those customers, it could run into problems? Supplier concentration, how much choice does it have in terms of its suppliers? Things like proximity to market and so on. Then we look at the efficiency of the firm, the operating efficiency, and we try to determine to what extent is this firm utilizing technology in achieving its business. So you look at integration of operations, whether it's vertical or horizontal. You look for whether it has locational advantages and multi-locational advantages. You look at its capacity. Does it have room to grow, or is it operating at near full capacity? And you know, you'd want to look out for, if this firm has to expand, does it have the wherewithal to be able to expand easily? Then some very subtle but important things would be like the staff turnover rates. If you have a very high staff turnover rate, that is not a good sign. And as you know, that's very expensive to be hiring staff and training staff and then losing them. So that affects your operating efficiency directly. Things like availability of skilled labor. We look at the importance of adherence to the environment, environmental regulations. And generally speaking, you're trying to identify, you know, the ability of this firm to be able to manage its costs, because that really is at the heart of the success of SMEs, the ability to manage costs. Then we go to the management, and this is a very subjective area, but perhaps the most important area in looking at the creditworthiness of SMEs, because, you know, management, in case of an SME, management really would make or break the company. And so you're trying to get an idea of the competence of management. You're looking at the experience, training, qualifications, yes, but more so experience in running the business, right? So you're looking at their track record. You're looking at what kind of systems and processes they have in place. You also want to see that there is some level of support for the main promoter, some second-tier management, so that if the main promoter is out sick or has to travel or something, the company doesn't just shut down. You're looking to see if there is a documented business plan. A lot of SMEs, when you talk to them, they say, well, I have an idea of what I want to do. The business plan is in my head. But that is not good enough. You want to actually get them to the stage of documenting it so that it keeps them on track when you have a document that you could refer to as time goes on. Also, a very important thing for SMEs is the ability to network, you know, ability to access support through networks, associations, and so on. Very, very important for this sector. And succession planning, very, very, very critical, because A lot of SMEs, they bring up the business, they grow the business up to a certain level, and they really have no clue as to who is going to continue this business if something should happen to the main owner. So succession planning is very, very critical in terms of assessing the overall risk of this enterprise. So you getting an idea of the management risks. You're looking at the appetite for risk in terms of their growth strategies, their diversification. Some SMEs, you find that whilst diversification is good, they are involved in too many things, and so they get distracted from the core business, and the core business suffers. So you want to keep your eye on that. And just generally in terms of their dividend policies, are they taking out all the money out of the business by way of dividends, or are they reinvesting money for the growth and development of the business? All right, and generally speaking, you want to get an idea that they are, not in violation of any laws and regulations and so on, and they have a good standing within the community. And then the final area we look at is the financial risk. And in this area, now you would be looking at both the quantitative aspects as well as the qualitative aspects. And so in terms of the quantitative aspects, you look at their existing financial position. You'll do an assessment of their ratios and so on. And the normal ratios, you would look at, profitability, growth, liquidity, and so on. And basically, you want to see that this company is able to manage itself through a cycle. So as I say, these are some of the measures you look at. But we also, the rating is not just based on historicals, but it's also forward-looking. So here's where the innovativeness now of the SME comes in, because you want to see what plans does this company have towards moving forward in the future. And you actually do some financial projections based on not only their historical track record, but the plans that the company has right now, so that gives you an idea of where the business is going. Accounting quality is important. You want to see that the company is managing, it has some level of accounting, and who are actually preparing these accounts. Is it an in-house accountant, or do they have an auditor, an external auditor? That makes a difference in terms of the overall transparency of the business. Right? Do they have a good repayment history in terms of past debts and obligations? And financial flexibility is something where we measure, how easy is this firm in times of difficulty to be able to access funding at short notice? Does it have a good relationship with its banks so that it can just draw down on an existing line of credit? Or the promoters themselves, do they have deep pockets so that if the company runs into problems, they would be able to at least provide some funding, even though it might be short term? So we bring all these elements together into a model, a rating model, and we assign scores to each one of these areas, which I would have gone through there. And the weighted average score then defines what the rating would be. And as I said, the rating goes from SME 1, which is excellent, right down to SME 5, which is a weak or vulnerable firm. All right, so that you can actually, based on the score that it gets, you place it in one of these categories. Now, this model we found it's gaining rapid acceptance in the market. We launched the model last year, 2011, in a pilot project with the Bankers Association of Trinidad and Tobago, as well as the IDB, who provided the funding. And it's very interesting in that we did a pilot project of 25 SMEs, ranging from many industries: shipping services, manufacturing, retail, entertainment, and so on. And just to give you an idea of the size of the firms who were part of this sample, the average annual sales were somewhere in the region of 11.6 million TT. Total assets were about 10.4 million, and number of full-time employees, 44. And what we found is that there were a number of success stories coming out of these ratings, because these firms were able to actually use the rating and renew existing credit lines with their bank. A couple companies were actually able to go to different banks and access new loans from the bank with their credit rating report. We have a very good case of a company that was able to, who received the SME 1 rating, And they went back to their bank and say, well, this is an independent report of my company, and we are actually rated excellent. And we would like to renegotiate our interest rates. If not, we're going to go to a different bank. And they were able to reduce their interest rates on all their facilities by 1%, which for an SME, as you would imagine, is a lot of money saving there that could be reinvested into the company. We have a case where a company was able to actually attract a joint venture partner into the business as a result of this independent assessment. Companies were able to negotiate credit from international suppliers because the suppliers feel that more comfortable now to deal with this company knowing that there's an independent body basically analyzing them and monitoring them. Most of the SMEs who were contractors and so on were able to procure new contracts by way of including this SME report in their package. And generally speaking, they were all able to effect improvements in their business because that's the main thing about this SME rating tool is that it prepares the company by pointing out in all the main areas that the bankers would be looking at in any event what they need to do to strengthen their firm and to be able to access further funding. Right? And one of the second aspect, the utility, if you like, of this SME rating is that it is also meant to help the banks to tie interest rates to the actual credit ratings. So it's moving the banks to the direction of risk-based pricing of loans so that they don't charge just one size-fits-all kind of rate to all the SMEs, but rather identify that they're excellent, strong SMEs who deserve to get a lower interest rate. And so this provides a framework rather for you to distinguish between the interest rates. We are also saying that the SME rating is a good forerunner for companies to be listed on the SME stock exchange because you are getting a good understanding of this business and the strengths and weaknesses of this business and the growth potential of this business so that when you go for listing on the stock exchange, investors are already quite aware of the firm and its capabilities. So in terms of the process itself, it's a very short process. 2 weeks is the turnover time for a rating from beginning to end. And the cost of the rating is quite affordable. We've actually defined what we mean by SME. Micro companies we have from 50,000 US, which is about 300,000 TT. The cost of a rating there will be 1,000 US or $6,000 TT. And it goes right up to about 8 million US or 50 million TT. And the costs will vary based on the sales level. So having introduced this model, we are finding now that there are a lot of applications. For instance, one of the commercial banks, they have actually they're specializing in the SME sector, and they're referring all their clients now to us to be first rated because it helps with their own turnover time in terms of assessing the company before granting a loan. So it's very useful for them. So they're actually using our services for that. We were recently contracted by Nedco in their business incubator project. We are included now to actually assess the firms in terms of assessing their readiness to graduate from the business incubator. We are partnering with the Jamaica Manufacturers Association for funding from Development Bank of Jamaica for 25 of their manufacturers who are actually looking for funding now, and they're going to be including this SME rating as part of the package. So there are a number of applications coming out of the SME rating tool, and it was intended to be a Caribbean sort of solution for helping SMEs to access funding. So I would end there. Thank you very much.